Forex trading can get you results like this, and this in 1 hour or less per day from anywhere in the world. And the best thing is, you can make these profits trading hundreds of thousands of dollars of someone else's money without taking on any risk yourself. Once mastered, trading can give you more time, location, and financial freedom than any other career path that I can think of. And in this full course, I'm going to show you absolutely everything you need to know to start a profitable trading career. And you don't need to have any experience to watch this video. I'm going to take you through the whole process from introducing you to the basics of Forex all the way through to taking your first profitable trade. And in case you're wondering who I am, why you should listen to me, and how I have any authority on this subject, I've been trading for 7 years and I've built a full-time trading career for myself. And over the past 2 years, I've trained over 2,000 people just like you to achieve $21 million in combined results. Many of those people now making over $10,000 per month, and many of them also going full-time with their trading. So now that's out of the way, let's get into the lessons. First off, what is Forex? Well, Forex is an abbreviation for foreign exchange. And foreign exchange is a giant global market where the value of the world's currencies are traded against one another. It's kind of like stocks. But instead of buying and selling shares in companies, we are trading the value of different currencies. Every single day, $7 trillion passes hands in this market. So it's by far the biggest. It's also the second most flexible market behind cryptocurrency. Forex markets are open 24 hours a day, 5 days a week, meaning you can take a trade at literally any time except the weekend. Stock markets, options, and futures markets don't have this benefit. They have specific trading hours that you're confined to. But Forex markets don't have this constraint. You can literally take a trade at any time you want between 10 p.m. GMT on Sunday and 10 p.m. GMT on Friday. Of course, on Saturday and Sunday, the market is closed. So what do we trade? Well, you know that we're trading the value of different currencies, but we don't actually buy physical currency. In Forex, we trade contracts, and the contracts that we trade are called currency pairs, and they show the value of one currency against another. An example of a currency pair is Euro USD, which is the euro versus the US dollar. There are hundreds of different currency pairs available to trade, covering all of the world's global currencies, broken down into 3 main segments: major currency pairs, minor currency pairs, and exotic currency pairs. Major pairs cover the world's most important currencies and always include the US dollar. For example, EUR USD, which is the euro versus the dollar, GBP USD, which is the Great British Pound versus the US dollar, USD JPY, which is the dollar versus the Japanese yen, and NZD USD, which is the New Zealand dollar versus the US dollar. Minor pairs cover the world's most important currencies, but disregard the US dollar. There are a lot of these, but a few examples would be Euro GBP, which is the euro versus the Great British Pound, NZD JPY, which is the New Zealand dollar versus the Japanese yen, and CAD CHF, which is the Canadian dollar versus the Swiss franc. Now in the bottom segment, we have exotic currency pairs. These are currency pairs made up of one very popular important currency and an emerging markets currency. An example would be USD MXN, which is the dollar versus the Mexican peso. For the most part, you should trade major pairs. They have the most people trading them, there's the most money flowing around, and they give you the best trading conditions. Minor pairs are okay, but major pairs are better. And exotics have terrible conditions, and I wouldn't even bother looking at those. So back to Euro USD. Currency pairs are made up of a base currency and a quote currency. The base currency is always the first currency listed in the pair. The quote currency is always the second currency in the pair. The base and the quote make up the price of the currency pair. So taking a look at the price of Euro USD, we can see the price is 1.08538. This simply means that 1 euro is worth 1.08538 US dollars. And in order to make money trading, we would need price to go up after we buy at that level. So if you bought at 1.08538 and the market went up to 1.09538, you would make money. Now, another benefit of trading Forex over different markets is that because we're buying contracts, we can actually trade both ways. See, if you buy a stock and the stock goes down, you lose money because the shares that you own are worth less. However, in Forex, with the contracts, we're essentially just betting on whether the market is going to go up or down, which means we can actually sell the market and profit when the market goes down. And some terms that you need to know in relation to this are long and short, bullish and bearish. So what's bullish? Well, bullish is a name for a market that's going up. It's also the name that people prescribe to the bias if you think the market is going to go up. So if Euro USD is bullish, that means Euro USD is going up. If someone says they're bullish on Euro USD, that doesn't necessarily mean that Euro is going up now. but they think that Euro USD is going to go up. And what's bearish? Bearish is the opposite of this. Bearish is the name prescribed to a falling market, or a bias if you think the market's going to fall. So if Euro USD is bearish, that means that Euro USD is going down. If someone says they are bearish on a market, that means they think that market is going to go down. And what's long? Long is another word for buy. A long position is a buy trade. So if a trader thinks the market's going to go up, they would enter a long position, or they might say they're long on Euro USD. And short is the opposite. Short is another word for sell. So if someone says they're entering a short position, that means they think the market's going to go down and they're putting risk on a sell. So long and bullish are buy, and short and bearish are sell. How can I make money trading? Money is made by actually forecasting which way the currency pairs are going to go, and then buying or selling or going long or short in that direction. So if you think the euro is going to get stronger against the US dollar for the next 10 minutes, 10 hours, 10 days, any time frame you want, you would go long or buy Euro USD. And if you think euro is going to get weaker, then you would sell Euro USD. And the cool thing about Forex is that you can trade across practically any timescale. You could decide to get in and out of the market in 1 to 2 minutes, or you could hold a trade for a year or more if you really wanted to. Now, these different styles of trading over different time frames have different names. We have scalping, day trading, swing trading, and position trading. Scalping is trading where you get in and out of a market in a matter of seconds or a few minutes, looking to catch very small price moves. Day trading is where you get into a trade with the plan to get out in the next few hours or within the same day that you entered the trade. Swing trading is where we go for slightly bigger moves and we hold a trade from anywhere from 3 days to a few weeks. And position trading is where we hold trades from months to years. The most common forms of trading are day trading and swing trading. And the style of trading I recommend you start out with is swing trading, simply because this is the easiest and most passive way to trade. So if right now you're working a 9 to 5 job or you have commitments that take up a lot of your day, you can swing trade around that with no problems. It's also the easiest to master and it can bring you some massive profits. All you do is simply find a trade, get in, and then let it run for a few days to a few weeks, and it will literally work for you and make you thousands of dollars in the background. So to make money, essentially all we need to do is find a market that's trending either up or down and then get into a trade. And to clarify, a trend is simply a phase in the market where we're either going up or down, anywhere but sideways. And because Forex is so flexible, you don't have to bet on a trade for months or years. You can get into a buy trade while it's going up, and if the market starts to reverse, you simply get out, go short, and profit from the down move as well. Now, what is a pip? We measure the price moves that the market makes in pips. And the currency quote I showed you before is made up of pips, and that's the price for a currency pair. So for Euro USD at 1.08538, the 3 is 1 pip, the 5 is 10 pips, the 8 is 100 pips, and the 0 would be 1000 pips. Now you notice we leave the final number off, that small red one that you saw on the quote, that's a fraction of a pip. So when we're counting pips, we start doing that one number from the left. Always ignore the fraction. Counting pips becomes important when it comes to preparing trades and managing risk. And we're going to cover this in depth in a bit. So don't worry, if it's a little bit confusing now, I'll show you some live examples. All right, what is technical analysis? When it comes to forecasting the markets to find actual trades, we need to do analysis. And there are 2 key types of analysis we can use. The first is technical analysis. This is what I recommend you begin with. This is the most common form of analysis. Most traders use this, and it's the easiest to grasp and the easiest to master. Technical analysis is where we use price charts to work out where the market's going to go next by analyzing patterns within the charts. I'm going to show you my strategy in a bit so you can start learning from that. The second form of analysis is fundamental analysis. So what is fundamental analysis? Well, this is where we use politics, economics, and real-world events, as well as news and data to work out where the markets are going to go. Fundamental analysis is not essential. It can be useful, but it's not essential. And as a beginner trader, I would recommend you don't look at this just yet, because it's more likely to confuse you than help you. So for now, keep your focus on technical analysis, and in the live trades in a bit, I'll show you how this works. What is risk management? Well, because we are essentially betting on the direction of a currency, sometimes we are guaranteed to be wrong. In fact, most great traders are wrong half of the time, which means if you took 10 trades, you could expect to win 5 and lose 5. Trading success actually comes from balancing the wins and the losses, not getting rid of losses altogether, because that is impossible. So because we know we're going to lose a good portion of the trades we take, we have to use what we call risk management. And risk management includes strategies like taking trades that aren't too big and aren't too small, and being prepared to cut losing trades while they're small, while holding our winning trades until the profits become very big. So now you know the basics of trading. There are 3 things that you are going to need to get started: a broker, a chart software, and a trading account. So what is a broker? A broker is simply a middleman between us, the trader, and the commercial banks who facilitate our trades. So when we take a trade, the majority of the time, this trade is handled by a bank. But we don't go directly to the bank. It's too difficult, time consuming, and we won't even be allowed to do that unless we are, of course, a high net worth individual or we are licensed with them in some way. So instead, we place trades through an account with a broker, and the broker instantly executes it and handles everything for us. A broker is absolutely essential. If you don't have a broker, you can't even place a trade. It's important that you pick a good broker because many of them are shady, and I've heard terrible stories of brokers refusing withdrawals of the money that you've deposited with them. Also, bad brokers will charge you huge fees and commissions and eat into all of the profits you make anyway. If you want a good broker, I've been using the same one throughout my whole 7-year trading journey, and I've never had a single issue. There's a link to that broker in the description. So brokers make money in 2 ways, through spreads and commissions. So what is spread? Now listen up, because this is important and it will cost you dearly if you don't understand it. Spread is the difference between the buying price and the selling price that your broker offers. So on your trading account, you will see 2 different prices for a currency pair. These are called a bid price and an ask price. The bid price is the price that the broker is willing to pay for an asset, and the ask price is the price that the dealer is willing to sell the currency pair at. And the bid price is always going to be slightly lower than the ask price. So the broker is going to charge you a small premium to buy a currency pair, and they won't buy it back for as much as they sold it to you for. Usually the spread is only 1 or 2 pips, and this is totally fine. But spread will eat into the profits on every trade you take. So make sure you're working with a good broker like the one I recommended so that you don't get chewed up by spreads. What is commission? Now the second way that brokers make money is through commissions. And commission is a fixed fee that brokers will charge you for getting in and getting out of trades. Commissions aren't charged on every trading account, though I actually prefer accounts that do have commission, because generally accounts that charge a commission are going to have lower spreads. So really you can pick which one you want to pay. You can either pay commissions or you can pay by paying higher spreads for the trades you take. For me, commissions make the most sense. But you don't need to worry, because if you become a good trader, commissions and spreads are cheap enough to be overwritten by your profits anyway. So it's not really a big deal. Now, what is a lot size? When you take a trade, you'll have to choose a lot size to enter that trade with. A lot size is simply the size of the trade you want to get into, or the amount of units that you want to buy. A standard lot is 1.0, and this trade is equivalent to buying $100,000 worth of an asset. To trade this big, you'll need an account balance of around $10,000 or more, so when you're starting out, you'll most likely be trading micro lots. This is lots like 0.1 and 0.05. The smaller your lot size, the less money you can make, but the less money you can lose. If you trade very big lot sizes, you can make money very quickly, but you can also lose thousands of dollars in a matter of minutes. It's best to start out small and work your way up over time, always following risk management. And how do you know what lot size you should use on a trade? Well, that's very simple. We can actually be lazy and kind of cheat the system and use a lot size calculator. There are many out there. I like this one on my FX book, and you simply type in how many pips you want to risk, how much money is in your trading account, and it will tell you exactly how big your trade should be. What is leverage? Leverage is money that you borrow from your broker to open trades. The smallest possible trade that you can open with a broker is 0.01 lots, and this is equivalent to $1,000. Meaning to open this trade without using any leverage, you would need $1,000 in your account. And the maximum you could really make off this trade is $1 or $2 or maybe $3 or $4. So in order to make a lot of money and make a living without any leverage, you would need to be risking and trading with millions of dollars. And to get around this, Forex brokers build leverage into the accounts. Leverage is seen as a ratio style number, like 1 to 10. And leverage will vary from around 1 to 10 all the way through to 1 to 1,000, which is pure insanity. 1 to 10 leverage means you can take trades with 10 times the buying power of your trading account. 1 to 100 means you can take trades with 100 times the buying power. In my opinion, there's no reason to really ever go above 1 to 50 leverage, as all that you're able to do with huge leverage like 1 to 200, 1 to 500, or 1 to 1000 is risk way more money than you're supposed to, which, if you're following risk management, which is